Thanks for the introduction. You'll love this, Bob. A few similarities in there. I was thinking the great privilege in what I get to do is that I'm just immersed in markets all day, every day, in front of companies all day, every day. And I think if you do anything often enough or regularly enough, it really helps inform your intuition, your pattern recognition, and ultimately helps you differentiate what works from what doesn't. So that's what I'd like to talk about today. I'd like to talk about it with respect to thematic investing. There's always a theme that's alive and well in the Australian market. As Bob's probably already pointed out, AI is the most prominent, seems to be the most popular. I got here late. I was amazed at how many times AI had been mentioned between when I got here and now. Things like the energy transition, battery materials would also be familiar to you, albeit investor interest is somewhat waned. And then you've got these mini manias, things like milk and marijuana, which sound a bit ridiculous now, but seemed much more sensible and legitimate at the time. If you go back and use dairy as an example, we got to the point where Gerry Harvey was buying dairy assets in his listed vehicle, Harvey Norman. Maggie Beer bought a dairy asset within her listed vehicle. Gina Rinehart, again, part of the buying frenzy. But not all thematics work. So Gerry, I think, was all in for $75 million. That asset went into administration. Maggie Beer, last I looked, that asset was losing $28 million and was up for sale. And Gina's probably the smartest of all three because she doesn't publish her financials. Which leads me into my prediction, which is that thematic investing will perpetually underperform. So this is a graphic representation of what I think returns could look like in the future. They will be surely under market. So why do people do it? A simple, logical, tangible idea. It makes sense. You can see the thematic happening in the real world. The extension of that is if I can see confirmation of that thematic, the companies that are associated with that thematic will benefit from that. I think there's a bit of a flaw in that logic. One of the flaws is if you've had that idea, it's possible that you're not the only one that's had that idea. There's two key issues, I think, with thematic investing. One is behavioural. So just for a moment, just remember that a lot of these thematics, or all of the thematics, really start with a kernel of truth or a plausible premise, if you will. So that validates the thematic, creates positive price action. That in turn creates investor interest. That investor interest then translates into more price action. You can see where I'm going. You end up subject to confirmation bias because everyone else is doing it. You've got past performance as evidence of it working. And really all that does is culminate in hurting behaviour, which creates overvaluation, which turns into underperformance. The second of the two issues, I think, is the capital cycle. Thank you again, Bob, for stealing my thunder on this. More capital means lower returns. So best case scenario, more competition is probably your best case scenario, is that capital's deployed with companies who have more investor interest in elevated share prices, raise capital and deploy it. Your worst case is something where, use lithium as an example, an industry that has lower IP, is more capital intensive, results in overcapacity, and that can be disastrous for returns. Proponents of of thematic investing would argue, I'm not buying the whole theme, I'm just buying the best stocks within the theme. What I would argue is if you're not looking for sustainable competitive advantage as your first port of call, then you're just getting distracted. A few examples, again, going back to the dot-com bubble. What I think is really interesting here is everyone was right. The internet really did change everything. And despite that, you've spent 7 years enduring a lot of volatility for no return. Half the stocks that participated in that thematic were no longer in existence by 2004. And if your justification was that you were looking for the next big one, something like a Google, that wasn't even listed until well after all of the excitement had fizzled. Two of the most famous investors in the world, I think. One likes megatrends, the other likes moats. One has done less than half the return of the other with more than double the volatility. So I think that's a win for stock picking. And if you're a bit more data-driven than that, Morningstar have gone and done the legwork for us. The blue bar is thematic investments. They've done this across as many thematic funds and over as long a time period as they could get their hands on, and found that thematic funds significantly, I should say, underperform. So what do you want to do about all this? Well, I think we've already made the point that AI probably has the most enthusiasm and exuberance in the market at the moment as far as thematic investing goes. Only took me a few seconds to find a robotics and AI ETF After a bit of Googling, unsurprisingly, the returns since inception have been below the benchmark. I don't see any reason why that would be different going forward. So step one would be just avoid thematic investments. If you want to do better than that, just buy the index. The index doesn't underperform. If you want to do better than that, again, find an active manager with proven stock picking skill. They can avoid pitfalls. Like Nuix is probably a good example. That share price has benefited significantly from the AI thematic, albeit its earnings haven't yet. It still makes barely any money despite trading on a $1.8 billion market cap. It doesn't look like a good risk reward to me. And if you want to do even better than that, you can find a manager that can profit from these overvaluations. So if there's one thing to remember, it would be thematics and thematic investings will underperform. So just stay away from them.